Thanks very much for that. I am also pleased to see that about this time 10 years ago I was about to become chairman of the QCA, and I'm delighted to see it's still flourishing, and that I didn't actually manage to stuff it up. So the next hour we're going to be talking about the role of public markets and helping, as we've now seen, and hopefully not hindering the growth of 3 very successful businesses, and I'm sure Luke can probably talk about 1 or 2 others at the same time. I am delighted to have a great panel of successful entrepreneurs to give you a real view from the coalface, and hopefully some interesting stories as we go through. Furthest away and coming back is Andy Blundell, Chief Executive of Communisis. In the middle, Bob Holt, driving force and now chairman of Mears for probably 20 years now, almost. And finally, closest to me, Luke Johnson, who is wearing the badge of chairman of Patisserie Holdings today, but has other badges to wear as well, including Risk Capital, and I'm sure you read articles that Luke's written in the paper. Different businesses from different sectors. What is quite interesting is that we all found out that all these 3 gentlemen have something in common, which I will share with you at the end of this. So real examples of small and medium-sized companies, extensive public market experience, and we will have an opportunity, as with Gervais's panel earlier, to ask questions at the end. So if I haven't asked the right question, please feel free to ask whatever the questions that you want to put, and find out what's good, bad, and downright ugly about being on a market. I'd like to start a nice, easy question to set them all off, really, in terms of where it is, by inviting each of the panelists just to really introduce their businesses. I'm sure everyone knows a little bit about Mears, everyone knows a bit about Communisis, but just to sort of make sure that everyone's up to speed, and really just introduce their businesses and talk about the challenges and opportunities that you've faced in the last couple of years and the couple of years going forward. And then we'll come on and see how the markets may or may not help that. So, Luke, perhaps I could start with you.
Sure. So Patisserie Holdings went public about a year ago, on AIM, raising roughly £80 million. Approximately half the company is still owned by myself and my partners on the board. We have getting on for 200 bakery cafes around the country, and over recent years we've shown growth of roughly 20% per annum, driven through organic means by new branch openings. And in terms of the opportunities, I think we are growing in an expanding market. And as I say, we have a profitable formula that we're rolling out. I think in terms of challenges and threats, it's competition, and it's increasing rents, and I guess potential for inflation in wages that are the bigger issues for us.
Okay. Bob?
Yeah, I bought Mears almost 20 years ago as a small private business. Cost me nothing. It was a regional business based in Gloucestershire. And I was just looking for a vehicle to take to market. My background had been in the 80s. I worked for 2 of the biggest entrepreneurs in the 80s, and I think learned how to do things and how not to do things. And most people who do what I do aspire to want to do it for themselves. Took Mears public 7 months later, valued at about 3.5 million, 3.5 million, and just kept our head down, kept quiet. And then over the next few years, we hit a market right. We made the thing. I used to be good at making things boring, invoicing people and collecting cash, and because it was my cash in the early days, I was quite keen on it. And we hit a market right. That was the simple thing. Put a good management team together. Today, we won. You know, we were hugely successful. 35% compound growth in the first 10 years. Went onto the main list at that time, most successful share price performance over 5 years and 10 years. Went onto the main market. Today the business turns over £1 billion, employs about 20,000 people, and what it does is it works for central and local government, principally local government, maintaining properties. So we maintain about 14% of the nation's social housing, council houses, to you and I, and also provide care to the elderly people in their homes. So the same paymaster. So we draw down from the public purse. And what we did, and I think this is, for me, the disappointing thing, that the story never really got out there and still doesn't. we changed the way these services are procured in partnership. So we very much sit alongside a local authority. And the great thing is the average contract is 100 million, because it's about 15 million a year, and it's about 7 years in length in average. So for us, a great long-term partnership. We spoke yesterday, I won't dominate this, but we spoke yesterday about when I came into this, we had Serco, Capita, and my old company, Mighty, big companies up there, and people used to look down at us and laugh at us. And clearly we stand up there now and look down on them, because we just carried on with what we do, and it's high levels of corporate governance. I'm very pro the market, so and now we look at all these businesses which are in public perception failed to provide. Anyway, so and I chair a couple of other public companies.
Andy?
Morning, my name is Andy Blundell. I run Communisis PLC. We're a marketing services group. We floated about 15 years ago, and I've been chief exec. This is year 6. During that period, we've changed the strategy of this business quite considerably. And what we do is we help our clients, and that's people like Lloyds or Procter & Gamble, communicate more effectively, more profitably with their customers. We've grown the business 20% year on year for that 5-year period. We spend a lot of time with our clients. It's a very client-centric organisation. It's also an organisation that spends a lot of focus in terms of leadership development. Previously, my involvement has been in private equity with a management buyout, and before that with De La Rue. So I'm interested in both sides of this ownership debate today. We've developed a whole new agency called Persona at the front end of our company, and we've grown international sales from nothing to more than 20% during that 5-year period. As some of you who follow Communisis in the room may have spotted, there is a disconnect currently between our share price and the fortune of the business. That's not new, that's been a sort of trait for a period, but it's an interesting theme to open up in terms of the role of small cap businesses, fully listed such as mine, so I look forward to that.
So we should start with that, but we'll come back to it, I think. In terms of, my day job is advising companies about joining the market, coming off the market, raising money and doing everything in between. One of the things that's often asked of me when people are considering going public is, well, what are the benefits of being a public company? Now, I often wonder, because I trot out all the normal things that advisors do about access to capital and visibility and all this sort of thing, what value do you now, having been on the market for some time, really attribute to being a public company? Is it just simply access to capital, or are there other things? Well, go on. Luke, do you want to start?
I think one of the important points is that you are encouraging the stock market to fulfill its economic function, which is that, it's a way of channeling savings into British industry. And I think that's incredibly important. So although that's more of an ethical point than a sort of selfish point, I think it really matters. I think that public companies can help with your covenant with landlords. I think being a public company can help have option schemes that, arguably to those beneficiaries mean more. I think if you're a consumer-facing business, and as long as things are going well, I think the incremental profile that being public can help. And I think that, in a way, it forces most companies to up their game in terms of corporate governance and the rigour with which they manage the business. So I think that's helpful. While I'm talking, do you want me to talk about some of the issues that you face of being a public company?
We can come back to that. Right. The one thing you haven't mentioned is access to money.
Well, obviously, I'm taking that for granted. And it's not just the time you go public, but it's the fact that you've got paper you can issue as opposed to just shares. And for example, if you're running a private company and persuading a vendor of a business to take paper is quite hard. But actually, if they take shares in your business, that gives them an incentive. So that's quite attractive. And yes, you can raise money more often and more easily generally than if you're a private business having to borrow or raise equity finance from private equity or whatever.
Is that the same for you, Bob?
Yeah, I think also being a servant to the public sector, that recognition and that leverage on your balance sheet helps greatly. So yeah, I'm a massive fan of the markets. It's where I've applied my trade almost all my working life. So, yeah, you know, improved balance sheet, recognition, funding opportunities, albeit we haven't used them that much. But yeah, I think access to capital is fundamental, and your employee engagement.
Andy?
I think we're involved with a lot of big bids with big organisations. From a client point of view, it's helpful. It gets you through a number of stage gates quite quickly. The numbers are out there, the governance is out there, so I think that's good. I think it's particularly helpful in some overseas markets, so it gives you a sort of probity which assists versus other ownership structures. In terms of the access to capital point, I think that is the whole point for me. And certainly in the 5 years that we've been running Communisis, we've seen the high point of that and we've seen the low point of that. Back to this point about disconnected markets. I think the other point is that there's an issue about visibility in terms of market cap. So, you know, where is the market cap and how far does that market cap need to increase? And that seems to be considerably greater than it was some years ago. So in other words, you need to get bigger to get the visibility.
So the question is often raised with me about the costs of being public. You all think that's worthwhile, or do you think it's too much, or do you think it's too little? We'll start at the other end, you can come back this way.
Well, we made 16 million operating profit last year. I think the costs of being public are circa 10% of that, to give you a flavour. So yeah, it's considerable in terms of board cost, advisory, and and everything else. Hence the comment about expansion.
Me? Well, again, I'm going to temper most things, and I'll probably be against a number of people. I don't think the costs of being public are onerous. I think they are, lots of these costs, the bigger you get, you would want them anyway. So I think you'd want better regulation. I think you would want to be knowing that you're doing things right. And certainly you want to have the benefit of an access to capital, even if you weren't public. You'd want to know, or your bankers would want to know that you're doing certain things right. So I think, like Luke, I've had the benefit of floating something fairly recently and having floated something many years ago. And you will remember, Mark, because we wrote, I think I wrote the prospectus with Ian Kerry, when we floated 20 years ago. So that was probably a 30 grand fee, I think, then to get public in '96, with warrants, of course. It's a great deal different now.
Yeah.
So again, people have mixed views. It's easy for me because I've had a successful business primarily. I've also been there with some dogs, and I know.
And we've forgotten all those, Bob.
That was a long time ago.
It's difficult, yeah.
And I suppose, it's not just, the cost of actually doing deals, yes, they are a lot more expensive. It's just the ongoing cost as well, isn't it, in terms of maintaining that governance. And I suppose, I don't know if that's a factor, Luke, when you're looking at businesses, you've got some private, some public, which way you're looking to take them, or is it just in terms of the type of business as to whether you're going to bring it to market or not?
I think if you interpret the word cost in a broader sense, I think the issues that anyone thinking in the audience of going public should bear in mind are the following in no particular order. So dealing with the takeover code, which can be a chore, and even if you then delist, you're still subject to it for many years. There are the costs, as be said, and I think the cost is all about your size. If you're a £5 million company, then the costs are onerous. If you're a £500 million company, the costs, fees and no man, whatever, are relatively inconsequential. I think one of the major issues that faces all public markets is the presence of very short-term shareholders like hedge funds, and I think they are bluntly a menace. I think there is a challenge for smaller companies generally that faces the smaller broker community, because I worry that a lot of smaller brokers are not making a living, and that if they don't all merge, then if they start to disappear, things like analyst coverage could evaporate. And for smaller companies, that's a real issue. For a lot of businesses that have been owned by private equity, where you have, significant option or incentive schemes, the stock market struggles with the more, shall we say, generous ones of those. And so management who may have perhaps enjoyed schemes where, for argument's sake, 15% say of the equity was effectively under option, that is not generally possible. You know, the institutional shareholders won't tolerate that. I think boards can be a challenge for public companies. Again, I think this is more big than small, but most of the best companies I've been involved with have had very compact boards of maybe half a dozen of us, all very aligned, quite often all shareholders. One of the more fatuous rules, that, well, I don't know if it's a rule, but recommendations, is that non-executives generally should not be shareholders in the companies on the boards of which they sit. Well, that's clearly a preposterous idea. And it, you know, is a very stupid recommendation. And I think.
How do you feel about options?
Well, I think that,
again,
I'm all in favour broadly. You know, you want aligned interests with people who are after capital growth, because that's what it's all about. You know, you're not looking for a dividend stream from a smaller PLC, are you? And I do think that boards in the public arena these days, particularly bigger ones, are at danger of suffering from ill-advised political correctness. I won't go any further, but what it can lead to is, you know, inappropriate, incompetent board members. And you see this in giant American public companies, I'm afraid. So they're just a few of the issues, all of which didn't put me off taking Patisserie Holdings public. But I think for those who haven't been involved with running a public company before, you need to, you know, become familiar with some of those issues before you take the leap.
Mm. Thanks. Andy, you've mentioned disconnect on price twice in your two of your three opening bits of remark there. But just sort of, I suppose I was sort of broadening that out in terms of, has that stopped you doing things or hindered you in terms of some of your growth plans, in terms of where you felt the way the market is actually valuing the business?
I think there's a frustration with it, inevitably, and there's also a visibility within organisations about share price, because you've got people with share save schemes, you've got option holders and so on. I mean, it's not, it's quite regular for me to walk onto a shop floor in Liverpool or wherever, and some guy come along to me with his smartphone and say, Andy, you're putting out all this good news, so how come my options sort of not where I thought it was? So I think it is, you know, it is blinking there. I think we're used to it being somewhat disconnected, but I think that overall it comes back to this size issue. And my take currently on visibility in small cap is 250, 300 million market cap. I think below that, it is difficult. It's a thin market. It's affected by retail, you know, etc. And yet one has the cost. I should hastily add the business is doing fine.
Yeah.
You know, hence the frustration.
And is that something else to do with analyst coverage? Because that was
brought
up earlier this morning.
That was made earlier. I think it is increasingly difficult for advisors to cover businesses in a way that makes sense for them, makes sense for the company, and therefore the available channels of communication are reducing. Quite sensibly, because as Luke said, you know, it doesn't make sense for the advisor to be doing stuff. So yeah, that is getting the message out there is a bit of an issue.
I suppose, Bob, Mears somewhat bigger, so presumably you get bucket loads of analyst coverage.
Do
you actually feel that there is some sort of connection between the value you think the business should be and the share price? Or I guess it's something you don't watch every day. Most people probably don't.
Well, without shouting, I've had most of my money out anyway, so I can't really complain about what people write. And I was taught early that you never try and deflect an analyst away from what he wants to write, because he has got the freedom to be able to write what he wants. I think I took an issue with one analyst once when he wrote, "We were surprised by how good the management was in this business." And I rang him up and said,
"It should have been flattered.
What sort of idiot are you? Do you think I'd employ imbeciles or something?" So that was probably, I think, one of the darker moments. I think, yeah, we get lots of coverage, and you know, we've got a long track record, so you don't want to really hear about Mears. I think one of my frustrations, if I might, even in this, is this idiocy around the lack of independence from a non-exec. The day, you know, he served 9 years on your board. you know, this view that he suddenly gets tempted by the executive team to sort of nod things through. And, you know, I had two of the most obnoxious non-execs from the start of being floated, and they kept us honest. And, you know, they confronted us. So when I had to let one of them go, I was deeply frustrated. And we basically put him into a subsid, to chair a subsid, because we knew he knew the challenges of the business. So, you know, I think some of those ticking boxes really does not fit well with me. But in the round, you know, I'm generally happy, and I think, you know, I would go back into the public market tomorrow, a la Luke, you know, if I had the right business, which I had. For me, it's all about having a business that's sustainable, that's having regular recurring earnings. If you're in a volatile market, then in your own business, then the stock market is not necessarily a place to be, because you are going to get grief.
Very good advice. Yeah.
So only worry about the share price when you want to sell or you want to raise money.
Yep.
And otherwise, just keep your head down and do what you said you would do.
Get on with the business. If you get on with the business and the business does well, you'll do well. You'll make a fortune. Oh, sorry, you'll make a lot of money.
So in terms of looking back at what you thought before you started, do you think you were missold anything about the market when you came on?
Me?
Well, I'm going to ask all of you, but I just wonder whether if you look back and, you know, advisors like me told you it was all going to be wonderful, and actually it turned out not to be.
Well, from my perspective, we had a sort of, because we came to market at $3.5 billion valuation, I met people I'd never been used to, because I worked for a FTSE company before. So I met people who spoke a bit differently, like I do, I suppose, and who said, all right, mate, we'll stick a quarter in that, and I'd never been quite used to that. So when we came to market, it was quite different, and I thought, what the hell have I let myself into? But again, in the round, everything's gone fine. So, yeah, we've had deep frustrations. And I'm Marmite, you know, I mean, half the city hates me, and the other half would prefer to hate me. So, just, you know, I think they put up with you, don't they? You know, and I've been around, I'm a dinosaur now, so I've been around far too long for some of them. So, overall, delighted.
I think the biggest misleading thing they can tell you is, we can raise you the money, and then they can't.
Yeah.
And I can remember in the 90s when we took Topps Tiles public, Strauss, I can be rude about them now because they don't exist, Strauss Turnbull were the brokers, and my colleagues on the board, who were the founders of Topps, chose them. I'd recommended 3 brokers, and they were the one I didn't want, and they chose them, and I said, okay, if that's what you want. And it wasn't a lot of money we were raising, it was like 8 million quid or something, and they only raised 6. And 2 days before, you know, the offer was due to close, they were, you know, $1.5 million short or whatever. And it was a wonderful windfall for me, because I wasn't selling any shares. And so, you know, essentially the gun was pointed at the heads of some of the shareholders, including me, and I put a lot more money in. Well, of course, the shares multiplied about 25-fold while they were during the period when I owned shares. And I'd obviously invested more in the float, not taken any money off the table. But I think at the end of the day, for anyone who's ever been on a roadshow where you've got to raise some money and you aren't, that's the biggest difficulty you will ever encounter, I suspect. You know, and not all brokers will always deliver in terms of their fundamental job of raising you the money.
I don't suppose you go to many, when you're raising money these days, I don't suppose you do most of it in the pub either, like you used to do. So.
I don't know what you're talking about.
I think times have changed there, Bob.
I do own pubs, but that's different.
Yeah, that's different. Just looking a little bit then at investor relations, how do you find dealing with shareholders and stakeholders? Have you found that it does take a disproportionate amount of your time in terms of, or longer than you thought it would in terms of where it is, which is often what I hear. Andy?
I think the comment that Ray just made is, if you run a business of a certain size, there's a certain formality to it anyway, irrespective of the governance or the ownership structure, so fine. I think that the investor relation calendar has stretched out, so it's gone from sort of interims, prelims to more of an ongoing process, which is, you know, which is fine. It does take up a reasonable amount of time. We do take it seriously, and you know, we're concerned to get the message out there. We did a calculation at one point that said that circa 20–30% of our time was being spent on a full year basis in that sort of PLC type, type environment. You know, that obviously begs some questions.
And is that also, do you put a lot of effort into private investors, private client brokers as well?
We have done. I mean, I think at the risk of being a bit controversial, I would say that our view now is that we're interested in institutional investors, existing, growing and attracting new. That's what we're keen to do, and retail to follow. I think we spend a lot of time in the retail market at events and so on, which is fine, but it's highly volatile. It's therefore a secondary priority for us here on.
Bob, you were always very keen on private. I mean, in the early days, you were doing lots of private client roadshows and stuff. Is that,
very much
do you
so,
still do that, or do you think that's...
The boys do less of it now, but yeah, I used to make a day a month to go to Leeds and Manchester and Stoke-on-Trent and go and sit with a couple of private client brokers. And I thought it was very valuable, because just on the day where you do want your share price strengthening and some private client broker just steps in and buys 50,000, you know, it can be very valuable. And I'm sure there's still a market out there. There's lots of private wealth out there. And I think, going back to the point, I think fundamentally it's part of your job as chief executive of a public company. When you come to market, you have to go and do that. You've got to sell yourself. Paul Pinder, who ran Capita, you know, which I said earlier was broadly in the same sector as us, his view was the shareholders get me twice a year. They get me on results and they get me at the interim. And they're not seeing me any other time. And why? Because they want me to run the business. So that's one contrary view. It's not the one I had, but I can see his point. And I think somewhere in between, I'm sure, is the right way.
What I would say is, thank God we're not in America. I sat on the board of an American quoted company, and quarterly reporting is the devil itself. And we must never, ever go down that road, because basically in America, and particularly also because it's a big country, you know, boards, I reckon, can spend half their time just on road shows of one sort or another. And as soon as you finish one, you've got to start the next. And it can be relentless. And of course, it's quite seductive in a way. And it can become a big distraction, all that business of being feted in the city, if you like. But as Paul was saying at Capita, you know, ultimately, as the CEO or whatever, you're hired to run the operation, you know, not to be a promoter. So I think it's very important that one of the other things I would say, slightly repeating myself, is that beware the hedge funds, because they are not patient money. And what you want, I think, as a business owner, as a CEO or whatever, is patient capital. And I remember when we took Patisserie Holdings public, I said no hedge funds on the roadshow. They sneaked in a few. They gave them a few shares. Lo and behold, within 6 weeks, they were all out. I rest my case.
Okay. And private investors?
Well, actually, I rather agree with Bob that, you know, I wouldn't spend a day a week, you know, charming them. But on the other hand, I think actually they can be very supportive and long term. You know, again, I think it behooves us in the public interest to celebrate capitalism and encourage the public to invest their savings directly in British industry. It's a very important message we're sending there. And the most direct way of doing that is to have private shareholders in British quoted companies.
So to provide, and also to provide the liquidity and
pick
up small parcels of shares. Okay. Right, with risk of causing a bit of trouble now, what's your view on, and I get this a lot from people asking me what they should do about it, what's your view on bulletin boards?
Well, I just don't look at them ever, so I barely even know what they are.
I used to look at them, but I don't anymore. Honest.
Just purely entertainment.
Yes, well, I think that's probably exactly
that
what
was
I
dating websites you were asking about.
Yeah. Yes, I know that's the other. I think in terms of sort of a slightly controversial topic in terms of where we are now, but have you ever thought of taking your businesses private? That isn't me offering services, by the way. I'm just...
Well, I've actually done it twice, and the answer is it's the ultimate option if things don't work out. And, you know, I have to say in both cases, it proved the right thing to do. You know, sometimes the stock market just disowns a business for all sorts of reasons. It's too small, it's blotted its copybook, they don't understand it, you're doing a turnaround and the stock market isn't very good at interpreting those. And, you know, as Bob said, if you've got a volatile business and so forth, you know, there are generally speaking phases where companies are either going public, which is the tendency at the moment, but there are also periods when overall the market is undervaluing particularly perhaps smaller companies, and it's probably right that in various cases they should go private because a different form of capital is necessary.
I've never taken anything public.
Private, you mean?
Private, sorry. Beg your pardon. We've been courted by private equity a few times, but it didn't seem to fit for us, I don't think. We've been happy with having thousands of shareholders rather than one. And I think that's where I would be most comfortable.
Andy?
Well, I've done both. So I worked with LDC and done a very successful exit. And you can get great alignment in private equity. But that's not to say that the public ownership isn't appropriate. I think it comes back to what's right for the business and how do we create more value. And it takes me back to this point about getting larger on the public market.
Okay. Well, it'd be wrong sitting here at the QCA, bearing in mind the QCA is a lobbying and educational organisation, that we shouldn't ask questions of you such as slightly open-ended, but what changes would help you in terms of regulatory changes or governmental changes to help grow your businesses and take it forward from here? I'll start with you, Andy.
I checked this internally, and there wasn't an immediate sort of hoo-ha sort of response. I mean, there's usual stuff about red tape, reducing bureaucracy, and so on. I think one thing that I would highlight as being very positive is UKTI and growth in overseas markets. I think that's been a very helpful initiative and really meaningful and quite a difference to where we were several years ago. So we don't have a particular beef. Obviously, we like lower interest rates and lower corporation tax and all the rest of it, but it's not really a major issue.
And I think European legislation, which has been floated many times in terms of how it's going to affect the UK market, has been quite well defended by the QCA over the years. So I think the lobbying aspect of the QCA is very helpful, especially to companies of a particular size. So I personally don't see a significant amount of issues. Of course, any aspect of reduced taxation, any aspect of lesser regulation, the city is going to go through enormous change. So the role of the broker and the provision of analyst services is going to cause havoc. And so you're going to find brokers walking away from companies where they can't get future income. And I think organisations like the QCA are going to have to stand there and help smaller companies through a difficult period on that.
I think two rather general things I would like to see change in the country as far as business goes, both related to property really, is one, I do think the planning regime is not fit for purpose in terms of business. I think it inhibits growth and job creation, and I think to a degree we inflict this on ourselves, but the sort of NIMBYism mentality you get too often is a brake on progress for this country. And the other area is I do think business rates on property are wildly disproportionate. £25 billion a year I think it now is. That is a tax that must be cut. I think it is tremendously damaging to sectors like retail and hospitality, and they are the ones creating the jobs rather than the online world in the big numbers, and I think business rates are a menace.
Okay. Thank you. Well, I think it's your turn now. Does anybody out there have a question for our illustrious panel of three successful business leaders?
Hi there, it's Richard again from Accountancy Age, a Financial Director. I just wanted to pick up with the panel the thing Wynne Bischoff said earlier about their reporting to company reporting at smaller caps, and his suggestion that the companies don't believe investors read their reports. Investors say they do. I just wondered how investors and the companies in which they invest are so disconnected that they don't know what the other one's doing.
Yes, in case you weren't here earlier, Sir Wynne Bishop was just saying that they've done a survey of speaking to investors and also companies, and the companies are saying, why are we putting so much time into doing our report and accounts, because nobody reads them. And the investors are actually saying the complete opposite, particularly in small companies. Again, back to this analyst point, because there's no analyst coverage, they're relying more on the report and accounts in terms of where that is. So that's the context.
Well, I've always been rather impressed by the sort of Warren Buffett view of life, which is sit there in Omaha and read annual reports. And that's all he does generally, and he's undoubtedly the best equity investor over the last 50 years. I do think annual reports have become massively more opaque over the years. I think the regulators and the accountancy profession of others have, you know, unintended consequences of trying to be more helpful have ended up being less transparent and obvious. And so I don't think that's been a good thing. If you're a fund manager in the smaller companies sector, and a typical fund manager, I guess, he's got a big fund that's looking after 120 holdings, I'd be amazed if they were reading 120 annual reports a year.
I think it is your opportunity to market the company. I think you do have to ensure that you've got a set of accounts which tell everybody what you're doing. One of the best bits of advice I remember from years ago was don't have a set of accounts which are this big and this big, because they won't fit in a filing cabinet, Bob. You'll find a fund manager says too big, bin them. So, you know, just keep them to the basic standard A4. In saying that, as Luke says, you know, they are getting so onerous in terms of what has to go in them. And I was looking through ours yesterday because it was our AGM. So the amount of content going into them, but I think the front end is ever so important, because there are some shareholders who never get the opportunity to find out what you're doing. One of the big issues, of course, is where shares are held in nominee accounts. You know, of course, you're online, but then going back to the private investor, some of them still don't have access to that. So I think if you communicate with your shareholders, ask them what they want, what do you need. You know, the stock exchange put out I think it's about 17 or 18 years ago, the advent of the internet, you know, they were talking about. And it was a great document, and I kept it for years after, basically, do this, and do this. And I think if you follow those basic rules about communicating with your shareholders, you won't go far wrong. I
happen to think really the question is, do you have to have a great website, including your annual report? And I think most companies now do have good investor websites, which are, you know, an essential piece of communication.
Yeah, I mean, on that point, we do a lot of video, a lot of YouTube and that kind of stuff, and the best way to find out about Communisis in 3 minutes is to look at that. I think the annual report does become larger, it becomes more unwieldy, but we write it, and we write the front end of it, and we make sure that the front end of it is a meaningful piece of communication.
Yeah.
Okay. Another question?
Yeah, Keith Ritchie from Titan Holdings. Somebody made a comment earlier about the optimum size for being listed on the market. I think it's being north of £100 million market cap. That cuts out a significantly large number of companies below that level, including my company. Should we delist? Is there no future for us on the stock exchange, given that market cap?
Not at all, no. I mean, I'm a massive fan of micro caps coming onto market, and I think you should stick at it. As long as, I mean, coming back to the basics, have you got a sustainable business? Are you in incredibly volatile markets? And I think it's more those questions than size. I mean, we went from 3 million market cap to 600 million at our biggest. And of that, we only bought about 100 million of that. So fantastic organic growth. So, you know, it can be done. But you've got to hit the right market with the right team. You've got to make sure everything's in place.
But Bob, I do think you've got to take into account the points that have been made earlier. And certainly compared to 20 years ago, there are a far smaller proportion of the overall institutional investment pool is willing to invest in a company sub 100 million, firstly.
Yep.
And secondly, analyst coverage is evaporating for those micro caps. And that is a real, you know, it's a negative cycle, that. So it ain't easy if you're materially below 100 million market cap.
I didn't say it was easy, but that's what hard work's about, isn't it? So, you know, you've got to get out there and work it to earn your money.
I mean, the only thing I'd say about delisting rather than taking it private, and these are separate things, is, and I've done this, if you delist, you will still be subject to the takeover code, which is a right chore, especially if you're a private company no longer benefiting from being, you know, quoted.
Andy, you got anything else?
I think, as Ray just said, I think it depends on the nature of the business and what it's about. But certainly I would say my experience in the last 5 years is that threshold in terms of visibility has increased. And I think it's probably increased about threefold. So for a business like ours, which is full list, I think that threshold on visibility is about 300 million market cap now. That's my judgment.
And yet the vast majority of AIM companies are below.
Yeah, well, we're full list, we're not AIM.
No, I know, but yeah.
But AIM is, yeah.
Okay. There's a question here.
I'm Susanna Oliver from Oliver IR. You mentioned several times the issue of a declining analyst coverage and the accelerating trend of that decline. Do you have any do's and don'ts tips, you know, from your own practical experience, what companies can do, should do, in order to maximize what coverage there may be available, or if there really isn't coverage available, well, what do you do instead?
Okay. Who wants to start?
You looking for me?
Well, I don't think you should, you know, tout yourself around too much, because it can give the impression of being desperate. I've always taken the view that there's one principle to try to hold to when dealing with analysts and indeed investors generally, which is under promise and over deliver. Yeah. And if you get the reputation of being a company that does that, over time word will get out and you will attract coverage. And obviously, you know, success breeds success, and analysts like to cover growing great businesses that have potential to be much bigger, and they can get on the bandwagon early and spot them. I remember I was an analyst in prehistory, and I came across, looking in the FT once, a then obscure business called PhotoMe International. And I phoned them up and I said, I'm an analyst and I'd like to cover you. And the company secretary said, oh, we've been quoted since 1962 and we've never had a broker's report. How much do we have to pay to get one? And I said, no, it doesn't work like that. I come and see you in Henley-on-Thames. So I did, and I wrote the first broker's report on PhotoMe International, and the shares went up about 100-fold over the years following.
But you didn't buy any?
No, well, I was working as a stockbroker, but you know, that's a business that had done wonderfully well over decades without a single broker's report ever. So they aren't the be-all and end-all.
And I think picking up that point and adding it to the previous point, from my perspective, there are various stages you clearly go through, aren't there, in growing a company, public or private. And you have various iterations. At the outset, it's going to be difficult, impossible to get an analyst to write about you, so you may have to pay for research, so you may have to do that. You then have to get a following, and you're going to get that if you are sustainable and your earnings are increasing and under-promising, over-delivering. And then you will get some coverage, and then it is the snowball effect. But as long as you don't, you know, talk it up and fail, because the city is unforgiving, and it, you know, it's not just one set of results or even two or even three. You have some analyst or some fund manager will say, well, we've got to wait for another full year of results to come through to prove that it wasn't a hiccup. And so it's very difficult. But again, it gets back to the basics. Do you have a good, sustainable, growing business? If you have, there's no reason not to be in the market, and you will get the coverage.
Well, just a question for the three of you. How many analysts follow each of your businesses, if you know?
In our case, 3 or 4.
Mears, I think you've got 9.
Yeah.
3, but
3.
we're quite new.
Yeah.
But, I'm happy with 3. 3's enough.
Yeah.
So that's the house broker and
Two independents.
Two independents, or and do any of you use equity development or Edison in terms of for paid for research?
Ooh, no, too expensive.
No, we've probably gone past that stage, I think.
Yeah.
Yeah, I think to answer the lady's question, a good idea is to ask the investors whose research they rate.
Yeah,
It's a good idea.
Very good point.
We've done that.
And institutions themselves can cajole brokers to sort of do the
because I think
coverage.
there's quite a lot of coverage out there. I'm not so sure, how much of it actually gets taken seriously. So we've done some of that.
Okay. Take another question. Oh, Mr. Ward.
Do you see any difference these days between being on AIM and being on the main market?
Well, one big difference actually for owners is that you can preserve entrepreneurs' relief and freedom from inheritance tax, which, God forbid, they should scrap those treatments. But that's really actually important, and I think quite a lot of owner entrepreneurs don't realise that you can get those benefits. And there's this fatuous business of you've got to have 5% with entrepreneurs relief and things, which is something they should change, because actually it's weird, they disadvantage the smallest shareholders, so they give the tax break to the rich ones. That's a really good idea, isn't it? But that's a difference from the past.
We went from AIM, having been on AIM, I think, 10 or 12 years, probably in the end, and being on the full list does come with its challenges. I remember that fateful day when, the day before our results, our broker was saying, if the share price goes up 5p, you'll be in the 250. And fine, whatever. And the day of the results, at the end of it, when he said to us, if your share price had only gone up another penny, it'd have been the 250. I think his neck is still probably recovering from me having my hands round his throat, because I thought that it was probably more in his demand. So, any changes? Not really. Clearly.
What made you? Why do it when you did it?
I think, although we probably weren't the largest, there was probably a minerals company on AIM, we were certainly seen as being the darling of AIM, and I think people saw that it was a natural thing for us to go on to the full list. I think evolution.
And did it attract? I mean, most funds will invest in both. So
it didn't.
You didn't get
in
any
reality,
new shareholders.
No, you didn't get that benefit.
I think these days the vast majority of all the smaller companies, investors, can invest on AIM and do.
And you got the worst thing, because you got trackers who then put you into a all-share tracker, and then you're in it or you're out of it, and so therefore people who could be then in the 250 tracker, you fall out or you're not in, and you spend a lot of time then just going through the nonsense. Yeah, more volatile.
And no regrets about moving. You were of a size to make it.
Yeah, and I've got 2 other listed companies on AIM, and I'm perfectly happy with AIM. It's perfectly adequate for growing companies. More than adequate.
And just a further question, have you noticed any increase in what you have to do in terms of your regulation or bits in terms of, or is it nothing? Because I guess people obviously say you may have to put more circulars out to shareholders if you want to buy things of a certain size, but you've not really had any of that sort of bother.
No, we've always been full list, so I haven't been the other way. I think my only comment would be there's some logic in going AIM to full list. Obviously, we're growing. We've looked at going the other way, and I don't see much benefit in doing that.
And again, if you've got aspirations to grow your company on the market, you want to set out an AIM company broadly how you'd want it to be run if it went onto the full list anyway. So yeah. I don't think, there's not too much difference, but you do have the flexibility on transactions. That's one of the great things, of course.
Anyone else before we go for lunch?
want their lunch.
I think they want their lunch. Looks like it. Okay, well, I think it just falls to me, so on your behalf, thank our panellists, Bob Holt, Andy Blundell and Luke Johnson. And the answer to what they all have in common is that at one point or another, I have actually advised all of them.
Oh dear.
Thank you very much. If you'll show your appreciation in a normal way.